Price of oil has been volatile recently, and according to our featured guest today, there are two big gaps forming in the energy space. Joining us now to discuss, Andrey Yastrzeb, VP for Portfolio Research with TD Asset Management. Great to have you back on the program.
Thank you for having me.
I like this idea. It intrigues me of the two gaps that you're seeing right now. Let's take one at a time. The first gap, the oil price detaching from oil inventories. Walk me through this.
Yeah, so I have a chart here that shows the relationship between the oil price and oil inventories over the last decade. And basically, if you look at the x-axis, that's level of oil inventories, and I'm combining OECD inventories in oil and water, which are relatively easy to track and which market focuses on. And on the y-axis, we have Brent oil price. And basically, what it tells you is that when inventories are high, market is oversupplied, oil prices are lower, and vice versa. The interesting part is that the relationship between the two is quite strong. So just level of inventories or the year-on-year change in inventories explains over 50% of move in oil price on its own. So where it becomes interesting is that if you look at this chart carefully, and I know it's busy, but if you look at the red dot where we are today, with Brent around $69, that 4.2 billion of oil inventories, a billion barrels of inventories, that's the highest level that we've had if we exclude COVID in the last 10 years. So inventories are quite high. And over the last year, we were talking about oil where people were saying we are going into a glut, we'll see oversupply, but it wasn't in inventories. The inventories were kind of tight. Now we are seeing that inventories are elevated, but oil price at 69 doesn't reflect that. That $53 horizontal line, over the last decade, every time we had more than 4 billion barrels in these inventories, that was the average price. So we're about $15 above that. And then on top of that, the forecast pretty much for everybody for this year is that we will continue to build inventories going forward. So the question is why? Why is oil so disconnected from fundamentals here? And I think two reasons here. One is Iran. Obviously, there's a lot going on there. There's a risk of a major conflict potentially in the region that is critical for supply of oil. So I think market is correctly pricing in the probability that something major could happen to the supply of oil, and that's reflected in the price. And I think the other part is that if you look at the structure of inventories, some of the main trading hubs, like Cushing in Texas, like Antwerp, Amsterdam, Rotterdam, Antwerp in the Netherlands, like their inventories are not that high, so you can still make an argument that those trading hubs are not seeing this glut. But if you look at oil and water, there is a lot of inventory there, and a lot of that is sanctioned. But as we've seen with Venezuela year to date, those sanctions can come and go away very quickly, depending on what's happening geopolitically. So I think market is not really, market is focused on this tail risk that will have a big conflict in the Middle East, right? And that would drive oil prices higher. I think there's another tail risk on the opposite side, where we could think about what if there's a peace in Ukraine, and what if there's a deal with Iran, and could we see in 3-6 months all those sanctions lifted and all that oil flowing? And I think market has not discounted that right now.
Okay, that's the first gap. The second gap you're noticing is energy equities detaching from the actual price of the commodity itself.
That's also very interesting, right? We see oil price, like we have oil inventories that are elevated, but oil price significantly above historical average. Over the last 10 years, oil averaged $63. We're now at 69. If you look at this chart here, it shows performance of oil versus energy sectors in S&P 500 and TSX. So since end of 2024, oil is down 8%. So we had this oversupply, and oil has been trending down. The interesting part is that equities rallied about 30%. So there is almost 40% gap between the commodity itself and equities. And again, if you look at this, the question is why? And I think in this case, there are a couple of reasons as well. I think one of them is related to what's happening in the market and all the volatility we've seen in recent weeks, right? If you look at energy, it doesn't look too expensive versus the market. So current forward multiples around 20 times for the whole sector. If you look at what energy is, it's basically sort of immune to this AI disruption. Anything that you can touch, whether it's pipelines, whether it's oil and gas, metals, industrials, a lot of those stocks are rallying in this rotation. And I think the other part to it is that if you look at energy as a sector and from this rotation of fund flows perspective, energy in S&P 500 is only 3% of total index. Technology is 33%. So even a small shift out of technology into other sectors, that's lifting all boats, and I think that's what's happening right now. The really strange part about it is that when you think carefully about it, investors are trying to find safety in this volatile market, and they find safety in commodities, which is a bit bizarre when you think about it. Usually commodities are more risky and more volatile, but that's what we're seeing right now.
Okay, so let's talk. That's a nice breakdown of the energy space, some of the gaps you're seeing there. What about the energy valuations? How do we compare them to the valuations we're seeing for gold?
So I have another chart here, and I'm reusing the same chart we had in our last meeting in December, but this one is updated since then. And back in December, both gold producers and energy producers were roughly at the same valuation, right? Like in terms of free cash flow yield, they were both providing around 7%. So this rally that we've seen in energy stocks recently, in the last couple of months, drove valuations higher and free cash flow yields lower, respectively, for energy producers. Now energy stocks give you 5.5% yield, and gold producers give you 7% yield. I think what's interesting about this is the outlook and what's going to happen forward. And on that, I have next chart.
Yeah, this is about revisions, earnings revisions, and when we put energy against the gold.
Exactly.
Sector.
You know, it's one thing to explain what has happened and where we are right now. Like in Canada, we like to say it's all about where the pack is going, right? To make a hockey analogy. And here, if you look at where pack is going for energy versus gold, it's completely different directions. Over the last 2 years, energy revisions in green have been negatively, and it's pretty almost flat, straight line down, right, at the same slope. Going back to my point about oil prices being elevated versus fundamentals, if you have that reset lower, if Iran uncertainty is solved and oil prices reset lower, I think there's more to come in terms of negative revisions for energy. And even if you look at the revisions over the last 3 months or so, and look at that by sector, energy is at the bottom. It might be even among the worst sectors for revisions. So there's definitely a disconnect here where markets are looking at slowing growth or negative revisions for earnings, but equities are rallying. And for gold, it's almost the opposite. We see, obviously, over the last 2 years, gold rallied, lifted earnings for all the gold miners. But what's interesting there is, if you look at the companies that reported so far Q4 results, the realized gold price in Q4 was around 4,100, 4,200, somewhere in that range. Year-to-date gold price is 4,800. And a lot of analysts that publish their estimates on Bloomberg or FactSet, their assumed prices are kind of around 4,500 or below the spot price. So as long as gold just stays where it is, we would see positive revisions, and I think gold would need to reflect that. I think the other final point on valuation, if you look at what commodity prices have been priced into equities, for a lot of oil producers, they're already pricing in oil at 70 or above. So they're pricing in above spot at this point. And if you look at WTI, it's at $64 right now. Versus gold, a lot of gold producers are trading at a discount to price to NAV at current spot prices. So there is still upside. They're still not reflecting the spot price.